In 48 hours, gold and silver did something that most people are told can't happen. Gold, the asset that's supposed to glide through chaos, fell hard. Silver didn't just fall, it lurched. In the same window, the move was violent enough that one widely quoted estimate framed the wipeout as roughly $7.4 trillion of paper value across the two metals. 7.4 trillion. That's not a typo. That's a number big enough to make people assume there must have been a war, a central bank accident, or a headline so dramatic it would drown out everything else. But the strangest part was the timing. There wasn't a clean, obvious news bomb that explained the speed. There wasn't a single announcement that neatly matched the first big red candle. It looked like the floor dropped out with no warning. And when markets do that, there's almost always a hidden reason. Not a rumor, not a conspiracy. A mechanism. Because price doesn't move first in modern markets. Liquidity moves first, collateral moves first, margin rules move first, then price follows. That's the information gap most people never see. And it's why these episodes feel like they come out of nowhere. Institutions already know where the pressure points are because they live inside the plumbing. Here's the pattern interrupt. What if the drop wasn't a message about gold or silver at all? What if it was a message about leverage, clearinghouses, and forced selling? What if the no warning wasn't actually no warning, but the warning was written in documents most people never read, in percentages most people never calculate, and in flows most people don't even know exist? If that's true, then this wasn't random. It was inevitable. And once you see how liquidation cascades work, you start recognizing them everywhere. Not months after the fact, not weeks, sometimes in real time. Welcome to Market Decoded, where we focus on what the data actually says and what the market structure actually does before the story gets simplified into a headline. If you get value from breakdowns like this, consider subscribing the way you'd keep listening to a calm voice that's seen these cycles before. And drop a comment with where you're watching from, because it's always useful to know how far these signals travel. Now let's reconstruct what actually happened. Start with the timeline. The sell-off did not unfold like a normal risk-off day, where stocks fall, bonds rally, and gold calmly absorbs fear. This was more like a vacuum event. Early selling hit, bids backed away, volatility jumped, and then the market began tripping over its own risk controls. And that's why it felt like a trapdoor. Once that first layer broke, the next layer didn't have time to think. And that matters, because the metal markets are not just buy and hold arenas, they are collateral hubs. They are hedging tools for miners, refiners, jewelers, and industrial users. They are speculative vehicles for funds that measure exposure in notional terms, not in ounces. When those worlds collide under stress, the first question becomes, who is forced to act, and how fast? You can see the stress in the churn. Around this period, reported gold futures volume jumped to roughly 621,000 contracts, in a session where the prior comparison point was closer to 366,000. Open interest, meanwhile, sat near 540,000 and slipped only modestly. High volume with relatively stable open interest is a signature of battle. Positions are being exchanged and unwound, not simply added to. That's what it looks like when exit doors start to narrow. The visible story was simple. Gold dropped roughly 9% from its recent peak, and silver dropped around 27% at its worst point in that same stress window. Those are not normal moves for these markets in calm conditions. Gold is a deep liquid market that usually doesn't behave like a high beta trade. Silver can be more volatile, but a near 30% slide in a tight time frame is a different regime. And the signature we're talking about is urgent selling, not a careful rebalance, not a slow rotation, urgent selling that keeps hitting bids as they disappear. That is what a liquidation cascade looks like. A liquidation cascade is a chain reaction. It starts with a sharp move that forces some leveraged holders to post more collateral. If they can't, they're forced to reduce positions. That selling pushes price lower, which triggers more margin calls, which triggers more forced selling. The key is that the selling is not optional. It's not an opinion, it's a requirement. When that happens in an instrument that sits at the center of collateral and hedging, the speed can be shocking. Because margin rules are binary, either you meet them or you're liquidated. If you've ever watched a crowded theater where someone yells, "Fire," you understand the dynamic. The first few people move quickly. Others see the move and rush too. The exits don't change size, but the crowd's urgency does. In markets, the exits are liquidity. And in a cascade, liquidity shrinks right when it's most needed. Now, why would gold and silver be vulnerable to this in late January 2026? Because the pressure wasn't only in price, it was in the rules. In mid-January, the primary futures clearing structure in the US implemented a shift in how margins were expressed, moving to percentage of notional margining for key contracts. On paper, that sounds like a technical update. In practice, it changes how quickly collateral demands rise when price rises, and it changes how portfolios are stress tested. Think about what happens when metals rally. As price rises, notional exposure rises. If margin is tied to notional, the dollars you must post rise automatically with the price, even if volatility doesn't change. That means a rising market can quietly increase the collateral load on the very players who are long the move. And if those players are also levered elsewhere, that collateral load can become the breaking point. For the benchmark COMEX gold futures contract, often tracked under the symbol GC, initial margin was shown in the ballpark of $24,000 and 5%. For the benchmark COMEX silver futures contract, often tracked under the symbol SI, initial margin was shown around $32,500 and 9%, with higher stress tiers that can be applied in more volatile conditions. Those aren't small numbers. They're the toll booths on the highway, and if the toll suddenly increases, someone has to pay. Then, as the volatility hit, silver's margin requirement was increased again from 9% to 11%, effective after the close on January 28th. That matters because margin hikes during a decline are not neutral. They are pressure. They are a forced deleveraging instruction. It's a lever that a clearinghouse can pull to protect itself. The side effect is that it can accelerate the selling. So here's the central mystery, and it's the one that creates the no warning feeling. If the market is already thin and you increase the required collateral, it's not just that price goes down, it's that price can gap down. Because some participants must sell immediately, regardless of what they think the metal is worth. But that still leaves a second question. Why was the trade crowded enough to matter? This is where the historical pattern becomes unavoidable. In 1980, silver surged into a mania and then collapsed under the weight of tighter rules and forced liquidation. The mechanics mattered as much as the narrative. Once leverage was pushed out, the fall was not a gentle retreat. The story afterward was always about greed and fear, but the engine was margin and liquidation. In 2008, gold offered another lesson that surprises people the first time they learn it. During the most intense phases of a system-wide deleveraging, gold can fall too, not because its long-term role disappears, but because it becomes a source of liquidity. When funds need cash, they sell what they can sell. Gold is liquid. That makes it vulnerable during the cash dash. In 2011, silver ran hot again. It climbed rapidly, enthusiasm peaked, and then the market broke. One of the major accelerants was a series of margin increases that arrived as volatility rose. The result was the same signature: fast selling that looked irrational, followed by a new regime where price discovery became harsh and jagged. Again, the narrative was emotional. The mechanism was structural. In March 2020, the playbook appeared in a different costume. Panic hit, markets sold off broadly, and even traditionally defensive assets wobbled. What followed was not a clean straight line. It was a stress test of funding markets and collateral chains. The lesson was the same. In a scramble for dollars, correlations go to 1, and liquid assets get sold first. And in 2026, the pattern rhyme is clear. A strong run in metals created large notional exposure. Structural margin rules shifted to track that notional more directly. Volatility arrived. Margins were adjusted again. And then the cascade. This is not opinion, it's pattern. Now let's talk about the players, because the players in a liquidation cascade are not just traders. They are exchanges, clearinghouses, systematic funds, banks, and anyone whose risk model forces action. Start with the clearinghouse and the exchange complex. When a futures position exists, the exchange is not the one taking the risk. The clearinghouse is. Its job is to ensure that if a participant defaults, the system doesn't break. It does that by requiring margin. When markets become volatile, the clearinghouse has a rational incentive: raise margin to reduce its own tail risk. That incentive is not evil, it's survival. But it has a predictable effect. It forces participants to either post more capital or cut risk. In a calm market, it's manageable. In a fast market, it's gasoline. Next, look at systematic flows. There was a separate pressure point that mattered in this exact window: commodity index rebalancing. When large index products roll and rebalance, they don't ask the market for permission. They execute. And when the assets under management tied to those indices are large enough, the flows become a market event. In this case, estimates tied to a major commodity benchmark suggested assets around $109 billion, with projected selling pressure on the order of $4.7 billion in gold. Futures and $3.8 billion in silver futures during the rebalance, including roughly 11,000 COMEX gold lots, around 3% of open interest, and roughly 13,000 COMEX silver lots, around 9% of open interest. Those numbers are a clue, not because they cause a crash by themselves, but because they tell you the market was already set, up for mechanical selling. If the tape is fragile, systematic selling can be the shove that starts the dominoes. Then there's the bank and dealer layer. Large banks run complex books. They hedge, they market make, they carry inventory, they also manage collateral. When volatility spikes, internal risk limits tighten, Options hedges change. Value at risk models demand reductions. And when those models tighten at the same time, margin rules tighten, the effective leverage in the system collapses. There's also the spread trade layer, which most people never consider. Many participants don't hold outright futures. They hold calendar spreads, option structures, or relative value trades that assume stable correlations. When volatility jumps, those relationships break. A position that looked hedged can suddenly behave like an outright bet. That's when desks start cutting across the board, not just in one contract. That's the hidden coordination people mistake for a plot. It's not a phone call between institutions. It's a shared set of constraints, triggered by the same inputs. Volatility goes up, margins go up. Everyone reacts within the same hour. Now add one more ingredient: the way markets behave around stress thresholds. Clearinghouses and brokers don't wait for a default to act. They look at intraday volatility, concentration, and liquidity. They can raise house margins above exchange minimums. They can reduce credit lines. They can demand additional collateral faster. That's important because it means the cascade can intensify even before the public sees an official margin notice. By the time the notice is widely discussed, the tightening has often already been felt in private risk calls. This is the part no one is discussing in plain language. Liquidation cascades leave footprints. They leave volume spikes. They leave rapid changes in margin parameters. They leave a sense of it happened for no reason, because the reason lives in the structure. Now, let's talk about the dislocation, because this is where the story gets interesting. During cascades, you often see two markets telling opposite stories. Meanwhile, the physical narrative can look very different. Demand doesn't evaporate, long-term holders don't suddenly change their time horizon, and real-world supply chains don't instantly reprice at the speed of a futures order book. Even without diving into every premium quote, the logic is straightforward. Futures can be sold instantly in size with leverage. Physical metal cannot. It moves through logistics. It moves through inventory. It moves through time. So in a cascade, paper can drop faster than the underlying physical ecosystem can even react. That creates a gap between official price and underlying behavior. Sometimes it shows up geographically, where different regions bid differently. Sometimes it shows up as inventories that don't respond the way the price suggests they should. Sometimes it shows up simply as the speed differential. Paper collapses in hours. Physical adjusts over days and weeks. There's also a second dislocation that appears inside the paper market itself: the difference between spot front-month futures and longer-dated pricing. In stress, the front of the curve can behave like a battlefield. Rolls become expensive. Financing assumptions change. Participants who intended to hold exposure through derivatives discover that their hedge now requires more collateral than their model assumed. If you've ever wondered why a small percentage change in margin matters, here's a concrete way to see it. A move from 9% to 11% is not just a 2-point change. It's a 22% increase in required margin relative to the prior level. For any participant running near maximum leverage, that's the difference between staying in and being forced out. Multiply that across thousands of contracts, and you can see how quickly selling can become unavoidable. And the gap cannot persist forever. Either the paper price stabilizes and mean reverts as forced selling ends, or the physical side weakens enough to validate the lower price. Historically, in metals, the sharpest dislocations tend to coincide with forced selling, not with a sudden permanent collapse in the fundamental story. So what exactly is the mechanism? How is a liquidation cascade executed in practice? It's executed through 3 levers: margin, liquidity, and hedging feedback loops. First, margin. When margin requirements rise, every leveraged participant faces a choice: post more collateral or reduce positions. Many cannot post because their capital is allocated elsewhere, or because they are running multiple strategies that are all under stress at the same time, so they sell. That selling pushes price down. As price drops, positions lose value, which further reduces available collateral. That triggers more calls. The loop tightens. Second, liquidity. In calm conditions, the order book is deep. In stress, liquidity providers widen spreads or step back. That's rational. They don't want to be run over by a one-way move. But when they step back, the same amount of selling moves price more. That means forced sellers get worse fills, which means losses accelerate, which means more forced selling. Liquidity disappears precisely when it's needed. Third, hedging feedback loops. Options dealers hedge. When price falls and volatility rises, hedges change quickly. If the market is moving through key strikes or widely watched levels, hedging can amplify moves. This isn't mysticism, it's arithmetic. When enough options are positioned in the same areas, the hedging flows can become another wave in the cascade. Put it together and you get the classic profile: a sharp initial break, rapid acceleration, as stops and margin calls trigger, and then a final flush where the last weak hands are forced out. After that, volatility often remains elevated because the market has discovered a new truth. It is not as stable as people assumed. Here's an analogy that makes it simple without dumbing it down. Imagine a neighborhood where everyone's home is financed with adjustable rate loans and the interest rate resets upward overnight. Not everyone will default. But the people who were stretched the thinnest will be forced to sell quickly. Those forced sales lower neighborhood prices. Lower prices put other borrowers underwater. More forced sales happen. Soon, even people who could have held are dragged into the price decline because the market price is now set by urgency, not by patience. That is what happens in futures when margin and liquidity tighten at the same time. The price you see is the price of the most urgent seller meeting the most cautious buyer. It's not the long-term referendum people think it is. Now, what does this mean going forward? Historically, when a liquidation cascade clears in metals, one of three things tends to follow. The conservative scenario is stabilization with choppy consolidation. Forced selling ends, margins normalize, and price trades in a rough range while participants rebuild positions and liquidity returns. In that scenario, the key indicator is whether volume and volatility retreat, while price stops making lower lows. This happens when the cascade was primarily mechanical and the underlying demand base remains. Once forced selling is done, there's simply not enough supply at the lower levels, and price snaps back in steps. In that scenario, watch whether open interest rebuilds without the same kind of violent volume spikes, suggesting healthier positioning. The aggressive scenario is that the cascade is the first act of a broader unwind across risk assets, where collateral stress spreads and forces selling in multiple markets. In that case, gold and silver can still bounce, but they may be dragged by broader deleveraging waves. The key indicators there are broader funding stress measures, sustained margin hikes, and repeated spikes in volume that suggest the system is still tightening. Notice what's missing. None of these scenarios require a prediction about where gold or silver must go. They require observing the mechanics. Are margins still rising? Are systematic flows still selling? Is volatility calming or escalating? Are liquidity providers returning or still stepping away? Are spreads behaving normally again? Because the market will tell you what phase it's in, not with commentary, with structure. And this brings us to the divide. There are two types of participants in episodes like this, not smart versus dumb, not insiders versus outsiders in a dramatic sense. It's those who understand that the first move is often about forced behavior, and those who assume every move is a vote on value. If you think every drop is a change in belief, you'll be confused when safe havens fall. If you understand collateral, you'll recognize that even the most defensive assets can be sold when something else breaks. That's why institutions move first. They are responding to rules and models. Retail moves last because retail is watching the story, not the structure. The information gap becomes a wealth gap, not because anyone is hiding a secret, but because the real information is boring. It lives in margin tables, roll schedules, open interest reports, and the quiet mechanics of clearing. Most people will never read those. They will only feel the consequences. So when gold and silver drop with no warning, the warning was there. It just wasn't on the front page. It was in the way leverage accumulates during rallies, in the way notional-based margin quietly tightens as price climbs, and in the way a 2-point percentage change can translate into a 22% collateral shock. One last detail to watch is whether margin stops rising. When clearing pressure eases, cascades end. When it keeps tightening, stress migrates. That single signal often explains why a chart feels calm one day and violent the next. This is market decoded, where we connect what the market does to why it does it before it becomes the headline everyone repeats. If this connected dots you hadn't lined up before, you know what to do. The question isn't whether these mechanics will show up again. The question is whether you'll recognize them early enough to understand what you're seeing when they do.